Yeah, and that's what I was going to kind of pivot toward your business and what that might mean for your business from the standpoint of loan demand, of financing demand, because against that backdrop, you have, markets near record highs. You've got kind of this risk-taking appetite with M&A coming back, IPOs coming back. How does all of that factor into your business, especially given, some of the uncertainties that are out there as it pertains to labor?
So I'd sort of the consumer, small business, medium-sized business clients away from the capital markets-oriented clients, because there's a whole lot of discussion there, and look at it in two parts. So if you look at the consumer spending, we talked about it, money in their accounts, credit quality good, equity in their home strong, a lot of good fundamental things. That's going to come down to labor and wage growth. If you look at small businesses, they're doing a pretty good job of earning money. But on their mind is labor availability, which is kind of interesting when you think about the Fed's question. So can we get the labor availability up so they can have people to work and do a good job with it? Then you go to mid-sized clients, and what they're doing is you're seeing they're not using their lines of credit quite as active as they did pre-pandemic. If you think about that, what would be the condition if you borrowed at 40% average uses, that you're borrowing at 35, 36? That means you're not as aggressive in the cost of borrowing went up. So as rates come down, that'll favor the small business, middle market borrower because they borrow off of short-term rates, and that'll be good, and that'll probably have them be slightly more aggressive. When you go to the market side, the IPO market is opening up. The private equity firms that have businesses they've held for a long time, they need to sell them, so you're seeing some strategic activity go on. You're seeing some large mergers that you talk about all day long in your shows. But there's a lot of activity. But I think if you think about that, that's going to take a good environment, and we think the economy grows at 2.4% next year. That's an environment where deals and things should take place.
And strategically, what does that mean for Bank of America? I know you had your investor day about a month ago, and yesterday we heard some guidance from one of your biggest competitors, JP Morgan, Marianne Lake there, providing guidance on expenses yesterday that surprised the street, at least temporarily. It bounced back a bit today. How are you thinking about their increased expenses in the context of what many analysts are describing to be this uniquely competitive environment for the banking industry?
With 4,000 people competing in the banking sector, then the non-bank sector, then the private equity funds, and the private capital funds, and the fintech, and all this, there's been lots of competitors. So I don't think that changes. I think at the end of the day, as we think about expenses and thought about it across time, the first way we can manage expense growth the most is about people, headcount, and we manage that very carefully, because what we always are trying to do is make our processes more efficient and take the savings out of that and plow it into the front end, client development, both people, products, new technology capabilities. So if you think about over the last 5 or 6 years, our headcount looks like it's relatively flat, but in that process, we added 4,000 technology coders. We added 2,000 people in the relationship management business going out in the field and covering clients. So you're adding people, but what are you doing? You're engineering out other processing capabilities. And as a management team, our team has the task of managing the human being aspect of that. So we have about an 8% turnover rate a year. That's 16,000 people. If we hire 14,000, we go down 2,000 people. So we have opportunities to shape the headcount, but you got to be ahead of it and do it. Our expense growth rate, I told the analyst earlier, was year over year, 25 to 20 over 24 was about 4.5%. Fourth quarter, we said it's year over year, it's about 4% plus. But if you add back, we had a credit from the FDIC, all of us got last year, fourth quarter, it's like 2.5%, 3%. In a 2.5% to 3% inflation environment, that's pretty good management. But you have to be on the process and engineering. We're investing a ton in the front. I mean, literally, we have, we're up to about $4.2 billion in annual initiative technology spend. This isn't the base. The base is $10 billion. This is just to put new products out there. And we're investing in people all over the world, in our international business, local business, salespeople. So you got to have that. The nature of our business is there's 4,000 competitors. So if you look at across long periods of time, the competitive nature of the industry has had us make it the same sort of returns across time, even though the return on assets in our industry has come down, because the competitiveness leads you to giving that to the customer.